we're new partners, and we feel blessed to be getting on board at such a critical time. And at the same time, we feel totally overwhelmed by all this information.
Yes.
So we appreciate
everything
that you're doing. But one area that I don't know if this is good for rapid fire, but we're trying to understand the Timothy funds, that portion of just analyzing it. It looks like there's, the upfront charges, the ratings, and so forth. So we wanted to learn just a little bit more about your interest in those funds.
So they're the only mutual fund company that's biblically responsible. They have been for 25 years. And anyone that has popped up has never really made it. They have mutual funds that you can totally diversify in because they have so many different ones. They have ETFs, which they have 4 really solid ETFs. They will never, ever, ever have good ratings because most rating agencies particularly don't like them, and they're never going to like them. Some companies won't even rate the Israel Fund, for instance. It's just not politically correct to say or do anything good. As a matter of fact, one brokerage in particular, Charles Schwab, they despise the company. You have heard, you haven't listened for that long, but you hear people calling saying how well they're doing over the years in Timothy. So there are still some big, even some big, very big mutual fund companies that have upfront fees. That's nothing unusual. But people say, and the ratings agencies, because of the way they operate, they may think the fees are high. But from the ratios on the fees are anything but high. As a matter of fact, they're below average. The thing I like about mutual funds, about Timothy, is that it's an area in which people have an option to use and to build their portfolio in a rather simple way, a little less complicated than building a mutual fund. And my strategy is based on building a mutual fund. So if you look at our asset allocation model for your age group, you'll see a lot of different sectors and a lot of different percentages. Mutual funds own a lot of different sectors with a lot of different percentages. I always have, before there was such a thing of Timothy, built my own mutual fund in portfolios because it's the same principle. You have a lot of sectors, a lot of positions, but not overwhelming any one position to have too many eggs in that basket of energy or that basket of technology stocks or that basket of healthcare stocks. So it spreads out the diversification, which is the most important thing of all in my strategy. It's the thing that I place the most emphasis on. So, but a lot of people don't want to do that. They'd rather invest on a regular basis in ETFs or mutual funds, and they can do that through Timothy and my Timothy asset allocation model. Hey, remember to click the subscribe button right here on the screen, and don't forget to hit the notification bell so you'll be notified when new content is added. And more importantly than anything, you don't want to miss all 3 live hours of Financial Issues every day from 9 to noon. And you can watch it on FISM.tv. That's FISM.tv.